Fundamentals of credit analysis. This is a relatively straightforward reading. A lot of what you will see here will look familiar based on what you've seen at level 1, specifically in financial reporting and analysis and fixed income. The reading starts with a basic introduction of why credit analysis is so important. It is pointed out that bonds outstanding are worth trillions of dollars, and hence it is essential that we do a good job of assessing credit risk associated with bonds and then appropriately pricing that credit risk. Section 2 gets into the basics of credit risk, gives you some definitions. Section 3 then dives into the capital structure, seniority ranking, and recovery rates. The point here is that when we assess credit risk, we need to first understand the capital structure of the entity that is issuing bonds. Any specific bond that we are assessing, we need to understand where in the seniority ranking in terms of priority of claims does a particular bond instrument fall. Next, we talk about rating agencies, S&P, Moody's, Fitch, the sort of credit ratings they assign, and the role of credit ratings in debt markets. Section 5 covers traditional credit analysis. Here we go over the 4 C's of credit analysis. Section 6 provides the basics on credit risk versus return, the concept that you have been learning all along, that if credit risk is high, then investors will demand a high return to compensate them for the risk that they are taking. Now, most of what you study up here is based on corporate bonds, and more specifically investment grade corporate bonds. In section 7, the curriculum provides a few basic guidelines on credit analysis for other kinds of bonds, such as high yield bonds, which are also called junk bonds, sovereign bonds, which are bonds issued by the federal government of a country, and finally municipal bonds. So these are bonds that are issued by states or cities or municipalities. You will notice that this is a fairly straightforward reading. The important thing for you to do is understand the most important points in each of these sections, and as I keep saying, spend time on the examples and the practice problems at the end of this reading. Credit risk is the risk that the borrower will default. Now, default could mean that the borrower does not pay the entire amount. It could also mean that the borrower does not pay only a partial amount. Furthermore, default also means that payments are not made on time. So default needs to be taken quite broadly. Credit risk has 2 components: default risk, which is also called the default probability or probability of default. If this probability is 0.1, so this means that there is a 10% chance that the borrower will default. The next important term is loss severity, which means that if the borrower does default, then what is the loss to the investor? If the loss severity is equal to 0.5, so this is generally written as loss given default, LGD. This being 0.5 means that for every dollar in default, 0.5 will not be recovered, or that will be the loss. So the expected loss is the probability of default multiplied by loss given default. In my simple example, that would be 0.1 multiplied by 0.5. So this is going to be 0.05. So for every dollar invested, the expected loss is 5 cents given this probability of default and this loss given default. Spread risk is another form of credit risk. Now, as a quick refresher from level 1, let's see what spread means. If you have a corporate bond with a yield of 8% and you have a comparable maturity government bond with a yield of 6%, then the spread is 2% or 200 basis points. Spread risk is the risk that this spread widens. So if for some reason the spread goes up from 200 basis points to 250 basis points, the risk of that happening is called spread risk. And the curriculum gives us two broad reasons why this spread might widen. One is called credit migration or downgrade risk. So if the risk of a particular bond or issuer being downgraded goes up, then obviously the spread will increase. The other issue is market liquidity risk. So if there is a risk that the market liquidity of the bond goes down, then obviously that will also increase the spread. So these are simply two factors that can contribute to spread risk. By capital structure, we mean the composition and distribution of debt and equity for a given company. So let's say that a company has total capital of 100 million. Then one possible capital structure is as follows. Bank debt might be 5 million, bonds might be 35 million, preferred shares might be 10 million, and common equity would be 50 million. So this is an example of a relatively simple capital structure. Some companies that have multiple subsidiaries, so if we have a holding company and underneath the holding company we have multiple subsidiaries, and then each subsidiary that might have been created because of an acquisition has its own capital structure that's different from the holding company, then we can say that the capital structure of this overall entity is somewhat complicated. Section 3.2 deals with seniority ranking. Here the curriculum essentially describes the concept of priority of claims. This means that in case of a default, who has the first claim on the assets or the cash flows? Take a look at Exhibit 1, which gives a sense for the priority of claims. Should there be any sort of a default, the first claim is with the first lien loan holders. So holders of this security would have the highest priority, followed by senior secured, then we have senior unsecured, then senior subordinated. So all these fall in the senior category. Now senior means that these bondholders will be paid off first, followed by subordinated debt. So subordinated debt has a claim after senior debt. Now within senior debt we have secured versus unsecured. The most secured form is the first lien loan. After that we have regular senior secured, then senior unsecured, and senior subordinated. Secured means that there is some specific underlying asset that is pledged as collateral. With unsecured, there isn't any specific asset or cash flow that is pledged as collateral, but the bondholder has a general claim on the assets or cash flows. So again, this is a general claim. And as mentioned before, after senior debt we have subordinated debt. In the case of a default, it is quite usual for the loss given default to be close to 100% for subordinate debt. Now the question is, why do companies issue subordinate debt, and also why would investors be interested in this subordinate debt? From a issuer perspective or a borrower perspective, it might make sense to issue relatively high risk debt because this debt is less restrictive. From an investor perspective, the return or the yield here will be higher. Given that the investor is taking higher risk, he will be getting a higher return, and an investor might feel that that return is justified given the level of risk. Now, this is rather obvious, but I'll state it anyway. The credit risk is relatively low with the senior debt, and credit risk is relatively high with junior or subordinate debt. Section 3.3, recovery rates. The main point here is that creditors who are at the same level of the capital structure fall in one class, and they will have the same recovery rates. So just to give an example, if you have two creditors, both who are in the senior secured class, one with a 3-year bond and another who has a 1-year bond, and in case there is a default, both will have the same recovery rate regardless of the fact that the maturities are different. So bottom line is, recovery rates are based on the class. The term used is pari passu, which means on equal footing. So all creditors who are in one class are on equal footing. A few general points about recovery rates. One, recovery rates vary by seniority ranking. So this is obvious. If the seniority ranking is high, then the recovery rate will also be high. Point two is that recovery rates vary by industry. So this is rather obvious. If an industry is in a decline, such as newspaper publishing, then the recovery rates will be relatively low. On the other hand, if there is a default in an industry which in general is on its way up, but temporarily because of a recession in the economy, there are defaults, but in general, recovery rates here will be relatively higher. Third point has to do with the fact that recovery rates also depend on when in a credit cycle they occur. So if we take the recent credit crisis, if a default happened in 2007, 2008 at the peak of the credit crunch, then the recovery rates would be relatively low. And finally, there is very high variability of recovery rates across industries, and there is also high variability across companies in a given industry. Now, a separate point related to priority of claims. What we have learned so far, or what we have implied so far, is that senior credit holders will get a claim before subordinate or junior credit holders, but in reality sometimes junior or subordinate credit holders and even equity holders might get back or recover more than what is legally due to them. Let's assume that a company has gone bankrupt. So there can be lengthy legal proceedings about the value of the company, the value of the underlying assets, and so on. To avoid those lengthy and possibly costly legal proceedings, what might happen is the various stakeholders, and that would mean creditors with senior credit, subordinate credit, and even preferred shareholders and equity shareholders might get together and agree on some sort of a compromise where, to avoid any legal proceedings, the subordinate credit holders and maybe even shareholders get a little more than is legally due to them. So the point is that the priority of claims that we talked about earlier is not always absolute. So what I want you to do now is example 3 from the curriculum, and in case you've not already done it, also go back and do example 2. A quick point on example 2 is that it talks about a second lien debt. The second lien debt is just one notch below a first lien loan. Then the rest of your secured debt comes after this. Section 4, rating agencies. Moody's, S&P, and Fitch are the 3 major rating agencies, and they play a dominant role in the bond market. There are several reasons for their dominance, And these reasons include the fact that the rating agencies are independent. So they essentially provide an independent assessment of credit risk, which is useful for investors. A given credit agency such as S&P uses the same standard to evaluate the credit risk across different issuers and bonds. So from an investor perspective, it becomes easy to compare different bonds based on their credit rating. Regulatory reliance. Even regulatory agencies rely heavily on the ratings provided by Moody's, S&P, and Fitch. The payment model, which is that issuers need to pay for a credit rating, is perhaps the most practical payment method. Now, this has received some criticism because of a conflict of interest where the issuer is paying a credit agency to issue a credit rating. And that might seem problematic, but the other alternatives, such as investor paying for the credit rating, has even more issues. And there is empirical evidence that suggests that issuer payment has not impacted or not biased the ratings that have been given by these agencies. Another important factor has been the huge growth of the bond market. Section 4.1 introduces us to different credit ratings, and essentially you need to have a good sense for this exhibit. So make sure you at least understand Moody's and S&P. Fitch essentially is similar to S&P. Investment grade means a rating of, if we just look at S&P, investment grade means BBB and above. You should also understand that within investment grade we can have high quality, medium and low investment grade. And if you stare at this for a couple of minutes, you can try and remember these different grades. The quick way to remember the difference between Moody's and S&P is that a 2 essentially corresponds to neutral, 1 in Moody's corresponds to a plus in S&P, and a 3 corresponds to a negative. Section 4.2 deals with issuer versus issue rating. The issuer rating is based on the general credit worthiness of the issuer, and we'll talk about evaluating credit worthiness in subsequent sections. Generally, the senior unsecured debt will have the issuer rating. So the curriculum gives the example of United Rentals Inc., and there the senior unsecured debt has a rating of B. So this issue will have, generally speaking, the same credit rating as the overall issuer credit rating. Now, many credit rating agencies do something called notching, which means that if we have debt that, for example, is below senior unsecured, so the curriculum gives an example of preferred stock, and this has a credit rating of CCC. So this is notched down. On the other hand, we might have senior secured. So this would have a rating that is slightly better than B. So that is notched up. So what are the factors that contribute to notching up and notching down? The obvious one is probability of default. So if the probability of default is less than senior unsecured, then we would notch up. Otherwise, we would notch downwards. The other factors that we consider are the priority of payments. So if there is a default, then who has priority of payments? And finally, loss given default. So if there is a loss or if there is a default, then what is the loss going to be? So these factors also contribute in coming up with the notching factor. You should also understand the concept of structural subordination. If we have a parent holding company with multiple subsidiaries, so let's say these are separate operating units, and let's say that each one of these operating units have issued bonds of their own, plus let's say the holding company has also issued bonds. When we talk about the credit rating, we need to look at this structure, and it is possible that bonds issued by the subordinate, here the cash flow generated by the operating subsidiary will first pay off these bondholders, and then only once these bondholders are paid off will cash be available for the bondholders of the holding company. So this again needs to be considered when we come up with credit ratings, and this overall concept is referred to as structural subordination. Investors are increasingly interested in making decisions based on environmental, social, and governance themes. Environmental themes include factors such as whether a company is trying to follow sustainable practices, a company is trying to reduce carbon emissions, or engaged in practices that are generally good for the environment. Social themes include whether a company has an inclusive workspace, whether salary gaps are minimized, and whether there is community involvement. Governance themes include areas such as whether a company is committed to a diverse board composition and strong oversight. And these are areas that we discuss in more detail in other parts of the curriculum. But the point here is that rating agencies are now also assessing companies according to their exposure to environmental, social, and governance risks, and then how well the companies are managing these risks compared to other companies. The companies that are doing well, or the leaders in this area, get high ratings such as AAA or AA, whereas the companies that are not doing so well on this front get lower ratings such as B or CCC. There is sufficient evidence that credit rating agencies have done a good job of assessing credit risk. However, as investors, we should still be aware of some risks in relying too heavily on rating agencies. The first point is that credit ratings can be very dynamic, so ratings can move or migrate up or down quite fast. Second point is that rating agencies can make mistakes, and a major example of this was in 2007, just before the major credit crisis. Credit rating agencies had given pretty good credit rating to subprime mortgages. Point 3 is that credit rating agencies generally do not do a good job of incorporating idiosyncratic or event risk, and that is primarily because of the difficulty of doing so. And finally, we should recognize that ratings will generally lag market prices of credit. So it takes some time to do the credit analysis. If there are potential issues that might cause credit ratings to go down, this will often be reflected first in the market prices and then in the credit rating. Now work on example 4, which captures the most important points from this section. Section 5 deals with traditional credit analysis of corporate bonds. The goal of credit analysis is to determine the issuer's ability to meet its debt obligations. And obviously, to do this analysis, we need to look at the strength of cash flows, we need to look at the balance sheet and the capital structure of the issuer, and so on. So the details will be looked at in subsequent sections. With equity analysis, we are concerned with how the company equity or company stock will perform in the future. The traditional credit analysis framework is to look at the 4 C's of credit analysis, which are capacity. This refers to the issuer's capacity to meet its obligations. The second point has to do with collateral. This is the strength of the underlying collateral, which is backing the credit. 3 is covenants. These are the rules, regulations, the terms that are helping ensure that the investor will get his money back. And finally, character of the issuer, and this generally has to do with the quality of the management team of the issuer. Perhaps the most important C in our traditional analysis of corporate bonds is the capacity to pay. And the next few slides will deal with capacity to pay. When we are evaluating an issuer, one of the first things we should do is industry analysis, and within an industry analysis we should look at the industry structure, and the curriculum recommends an analysis based on Porter's 5 forces, which you have seen in the equity section. So as a quick recap, we need to look at power of suppliers. So in an industry where the supplier power is high, maybe there are a few very strong suppliers, then the credit risk of that industry is relatively high because the suppliers can squeeze this industry. 2, the power of buyers or customers, and again, if there are a few strong buyers, then they can squeeze the companies in the industry, and that again increases credit risk. 3, barriers to entry. So high barriers to entry simplistically is a good thing. If the barriers to entry are high, that will potentially discourage new entrants, which hopefully will mean that profitability and cash flow is relatively high, and that would mean relatively low credit risk. 4, substitution risk. If substitution risk is high, which means that the product made by this industry can easily be substituted by some other product, a substitute product, then obviously the credit risk is relatively high. And finally, we need to look at the level of competition. If the level of competition within an industry is high, then the credit risk is high. This is a very simplistic analysis, but given that the curriculum hasn't spent much time on this, I don't think you need to get too detailed. Plus, you've seen this material in the equity segment of your course. Another important item to look at is the degree of operating leverage in industry and in the companies within that industry. If the degree of operating leverage is high, that means fixed assets are high, and here we need to be a little extra careful, because if our fixed assets are high or our fixed costs are high, then as long as sales are good, then the cash flow typically will also be good and the credit risk is relatively low. On the other hand, if the sales fall, then the cash flows and the profitability will fall a lot, and that introduces a significant amount of credit risk. So a worst case scenario will be high operating leverage in a very cyclic business, because when the economy is in a trough or a recession, then obviously the credit risk will be relatively high. After looking at industry structure, the next step is to look at industry fundamentals. Here we should look at whether the industry is cyclic or non-cyclic. Obviously, with cyclic industries, we need to be concerned about the level of debt. So an industry, if a company is in a cyclic industry, the level of debt should be relatively low so that interest payments are not too high when the economy is in a recession. Growth prospects, while this is typically important for equity investors, but even bond investors need to be concerned about growth, because if growth prospects are weak, that might imply a relatively weak company which might have trouble making coupon payments and principal payments. So not hugely important, but still a factor to consider for bond investors. And obviously, one should also look at published industry statistics about industry and make sure that the fundamentals are all right before investing in a company in that industry. Next is to look at company fundamentals. So we need to see that within the industry, what is the competitive position of our company that we are evaluating? What's its market share? How has the market share evolved over time? And so on. Next, we should look at the track record and operating history of the company. So what have the sales been like, what has the cash flow been like over the last few years, what are the capital expenditures relative to sales, and so on. We should look at the management's strategy and how well management has executed strategy. And obviously ratio and ratio analysis is extremely important, and that's covered in the next few slides. At this stage, I want you to work on example 5, which covers some of the concepts that we have spoken about. In terms of profitability and cash flow measures, this slide shows the most important ones, and everything here should be fairly familiar based on level 1 FRA. So EBITDA, this is a rough proxy for cash flow. So obviously we want this number to be high. Funds from operations, this is a metric used by S&P, and it is essentially net income from continuing operations plus non-cash charges like depreciation, amortization, and deferred taxes. Free cash flow after dividends essentially takes the FFO and subtracts the dividends. We want this number to be high so that there is enough money to pay off debt holders. And then we have leverage ratios such as debt to capital. Obviously, we want this ratio to be relatively low. Debt to EBITDA, we want debt to be relatively low and the EBITDA to be relatively high. So overall, we want this ratio also to be low. FFO, funds from operations to debt, we want funds from operations to be relatively high and debt to be low. So this ratio ideally should be higher. And then coverage ratios such as EBITDA to interest expense or operating income to interest expense, we want these ratios to be high. So there is no rocket science here. We need to evaluate a company in the context of other companies in an industry to evaluate how good the ratios are. It is important to assess the issuer's liquidity because a strong liquidity position will reduce credit risk. In terms of liquidity, we should study cash on balance sheet. Obviously, high amount of cash on balance sheet is a good thing. We need to consider net working capital, which is the current assets minus current liabilities, or we can also look at ratios such as current assets over current liabilities. And again, the higher the better. Operating cash flows, if operating cash flows are positive and strong, that's a good thing. We need to evaluate committed bank lines. So in case there is trouble, we want to be comfortable that this issuer can borrow money from a bank on short notice. And we also need to study debt coming due and committed capital expenditures in the next couple of years. So this will give a sense for the obligations that are coming due because they might impact the liquidity situation. Now you need to work through example 6, which is fairly long but extremely simple. You are given the income statement, balance sheet, and cash flow statement of a company, and then are simply asked to calculate ratios, evaluate ratios. So this almost is a recap of FRA from level 1. I'll not spend time on it because it's straightforward, but you need to go through this material and make sure you are comfortable. There are a couple of key points with regards to collateral analysis. The first has to do with the quality of collateral. And what this means is if there is a default and we need to liquidate the asset, then how much will we get for the asset? As an example, goodwill will be a very poor quality asset. On the other hand, investment property, land, for example, would be good quality collateral. The other point has to do with the total amount of collateral or dollar value of collateral relative to debt. So to be comfortable, we want the dollar value of collateral to be high relative to the amount of debt. Covenants are meant to protect investors while at the same time giving management the flexibility to run the company. Covenants can either be affirmative, which basically say that the company or the issuer has to do certain things, such as make coupon payments and principal payments on time, or covenants can be negative, which means that management cannot do certain things, such as take on additional debt. Covenants are documented in what's called a bond indenture. So covenant analysis essentially would be the process of figuring out whether these affirmative and negative covenants are indeed protecting the investor. Covenants are generally much more important in the context of high yield securities or junk bonds, but they should also be evaluated for regular corporate bonds. Character refers to the quality and character of the management team, and while this is difficult to assess, there are a few areas that we can look at. Number one, we can look at how reasonable is the current strategy of the management team, and what is the track record of the management team in implementing their stated strategy in the past. We can also look at the track record of the management team at their previous jobs and see whether they generally have taken the company to stronger positions or weaker positions. Obviously, if we have a management team that has a record in the past of leading companies into financial distress, then that would be a negative sign. We should also look at whether the management team is engaging in any sort of aggressive accounting. If it is, that would be a negative. We should check whether there are any reported incidences of fraud. We can also look at whether there has been poor treatment of bondholders in the past. So these are just a few items that are highlighted in the curriculum, and from an exam perspective, these are good enough. What you now need to do is work on example 7, which focuses on the 4 C's.